Okay, lot to talk about this week. Yields, credit spreads, double bottom on the equity market, and a war brewing in the currency field. Let's start with our par rates. Across the top this week, all of them, except the 1 month, all of them last week hit new highs for the year, with the 1 year to the 7 year hitting new highs on Friday alone. The 10 to the 30 and the 2 month and the 6 month hit their highs on Thursday. The next FOMC is a long time away, November 22nd, 38 days. This is the next signpost on the Fed tour, is the minutes from the September meeting we're going to get in 17 days. Look what's going on down here. Last week we had 3 measures of yield curve slope inverted. Now we have 4. We are now 80 days inverted. That is a high, or I shouldn't say a high. Well, I call it a high for the inversion, low for the slope, negative 51 basis points on a weekly closing basis, not on a daily closing basis, but on a weekly closing basis. That is the most inverted for the year. 80 days now. For the Fed balance sheet, still moving in the right direction, $16.7 billion down for the week ending September 21st. We're now under $8.3 trillion, $8.291 trillion. And on the last, after the Fed meeting, they minutes suggested that they plan to continue doing that, so that there's no slowdown in that. Nobody expected that to happen either. Already handicapping November for the Fed Watch tool. 73% basically on 75 basis points, 27 on 50 basis points. And year end, the distribution of the ending rate by year end, 4% is now gone. 26% roughly at 4.25. The weight of it is at 4.5%, which is consistent with their summary of economic projections. They're projecting 4.4 by the end of the year. The market sees no reason to question them. I want you to think about how rare that statement is. The market sees no reason to question them. Finally, do you think that they got everybody on the same page? If we go back to the August 7th market outlook, I had said at that time, given the market rally that was going on, that the Fed really had no choice but to go 75 in September, and that they would follow it up with 250s, and they'd end at 4.25. And this was back when the market had 3.5%. They were pricing in 50, 25, and 25. Now the 75 is done. They're pricing in another 75 and another 50 to get to 4.5. I'm still going to stick with the 4.25. I'm not sold on the 75 for November. Not enough visibility at this point in time. We have 2 jobs reports before then. You have the October and the November jobs report. I think we have PCE coming up at the end of this week. You'll have a CPI and a PCE next week. And being this is the 22nd, you'll have one more CPI report for November, but not the PCE. So we have 2 more CPI reports, 2 more jobs reports, and 2 more PCE reports coming. Plus, we'll have at least a good 30 to 35 days of earnings for Q3 behind us. I'll start to get more visibility then, but I'm just not seeing why we would do another 75 at that point. The message is, the market, I think, has received the message from the Fed loud and clear and are on board that I think if they went 50, I don't know that the market would start saying, oh my God, they're going to pivot. I think they would say, well, that's reasonable, as opposed to, reading something more into that doesn't exist. All right, a lot to see on this screen. Let's start with our real rates. All of them increased last week. All of them hitting year-to-date highs. All of them positive and inverted. Break-even rates, all of them pulling back from the 5-year to the 30-year. The 5-year forward is up 9 basis points. As I've said before, I don't think there's a lot of information in there when you're moving 4 basis points and 1 basis point. I don't think that there's a lot to see there. Let's look at the summary of economic projections. This is it right here, and this is the dot plot. So we'll look at both. we have the June projection, and the top line for each one is the September projection. So in June for 2022, the forecast for real GDP was 1.7, now sitting at 0.2. Same with 2023, 1.7 drops to 1.2, and 1.9 in 2024 drops to 1.7. If you look at the dispersion, the link for this PDF is in the description box below. This is a longer table that continues outwards across here. I just grabbed the first part of the table, but the third panel is the range from which this median was taken, and the only negative number for change in real GDP happens in 2023, that there is an overlap with negative real GDP growth. So they're still not on board with the fact that there is a looming recession in 2023 where we will have negative GDP growth. There is just a small overlap into the negative territory in the range of forecasts for 2023. The unemployment rate going up to 4.4 and hanging there for a couple of years, 3.8 by the end of the year. We're at 3.7 now. The June projections were just not that much lower, but this is a lot more realistic, 3.9 going to 4.4. PCE inflation, I still think, is a little aggressive here. 5.4 for the year, dropping to 2.8 by the end of 2023. They had it at 5.2 down to 2.6, only 20 basis points increase for the September projection. That in part probably comes from the fact that they downgraded growth so much. And the core 4.5 dropping to 3.1, then to 2.3. This is interesting down here. Again, the top line is September, and this is where they were in June. They are targeting end of 2022 at 4.4, end of 23 at 4.6, dropping to 3.9, then to 2.9. So we can see during 2023, 4.6 being higher than 4.4. There is no pivot in there at all. And from 2023 to 2024, there's a 75 basis point cut on average, and here another 100 basis point cut. If we look at the dot plot, here it is. How we read this is there are 19 people on the committee, and they'll each give a forecast for their year-end target for 22, 23, 24, 25, and longer run, and each forecast is a dot. And you find the middle dot. Since there are 19, you take off the top 9, you take off the bottom 9, and whatever dot is left, that is where the target, the median of the target. So you have a rate that looks something like this. If you're going to draw a smooth curve through it, that looks something like that. So we're going to end in 2022 at about 4.5%, going to 4.6% over 2023. So there'll be some rate increases in the first meeting or two in 2023, and then a long period of sideways movement. Well, if you call sideways being a movement, but being on hold. So the idea of a pivot is gone, but you have a Fed pause. I think that is what you can start thinking about. And I think that risk assets start to get some reprieve, some elimination from downward pressure once you pause. Once you have a pause, that's the first, that's the first stage of a recovery in equity markets, is that, okay, we're here. Let's adjust to these levels. What is interesting about 2023 is these up here. You got 12 of the 19 that are at 4.5% or higher. Note that nobody is at 5% across here, and there's no one at 5. And down here, you have nobody at 5% either. If I use a Taylor rule approximation using their numbers for 2022 and 2023, based on where we are now, 3.3% is what the Taylor rule, and again, this is an approximation, right? It's a Taylor rule saying, and I'm using 2.5% as their neutral rate, which Powell suggests is the neutral rate in around 2.5%. It could be higher, but 3.3, and they're at 3.25. If they go to 4.5, this is suggesting 3.3. Using their numbers for 2023, you get 2.6. If you just accept their output gap and their inflation gap, if you just accepted 3.3 and 2.6, where they're going to be at 4.4 and 4.6, and he did say they want to get into restrictive territory. Well, that would be restrictive. Given the conditions for the output gap and the inflation gap, the Taylor rule says 2.6% is an appropriate rate. Anything higher than that would be more restrictive than necessary, and anything lower that would be more accommodative than necessary. So they do want to move into restrictive territory because it's this gap that they're concerned about the most, the inflation gap. They do want to get there and stay there for a while, so this has now become consistent. It is consistent with what they said. And during the press conference, Powell says that with this latest rate move, they've moved into the lower range of restrictive, into the lower range. So what range they think is restrictive, well, we have down here, right? If you can look at the dot plots, that is the range that they think is restrictive, and they believe they've moved into the lower range of that restrictive range, which means they are going to move higher. From the statement that was released at 2 p.m. from September 21st, I've compared the first paragraph with July 27th. Actually, I compared the whole thing with July 27th. It's word for word from July 27th. The only thing changed is in the first paragraph, the very first sentence. When they talk about ongoing increases in the rate, both in July and in September, said that the committee feels that ongoing increases in the policy rate are going to be appropriate. So there's going to be more rate increases. They're not done. They're not ready to pause. How much longer that's going to go on for, we don't know, but we'll have to watch the release from November. And do they say the same thing? Ongoing increases are appropriate, or do we see that a few more increases are appropriate? We don't know. But look at July 27th, the first sentence. Recent indicators of spending and production have softened. That's gone. Recent indicators point to modest growth in spending and production. So in July, they were telling the truth. They were saying, well, look, we see what's going on in the economy. And I think that's where the market said, aha, they're recognizing that the economy is weakening. They're not going to be able to raise rates to as far as they want. We got to pivot. There's going to be a pivot. The Fed's not going to keep going because this is already happening. So they said, okay, well, let's just remove it. They gave the market no room to interpret anything. Recent indicators point to modest growth in spending and production. So they're not even going to acknowledge if there's weakness in the economy. They're not even going to acknowledge even seeing weakness in the economy. They're going to say, the economy's doing just fine. Thank you very much. There's growth going on. It's not great growth. It's modest growth, but there's growth going on. Leave us alone. That is the only sentence that changed. I find it interesting that the language has changed because July really was Powell's fault. I mean, if we think about the rally that happened off of that press conference and that continued on until he had to come out at Jackson Hole and read the riot act, he knew, I think they all knew that it was his language, and they just sort of couched it in the terms of, I don't know why the market has interpreted a certain way. You don't? You don't? Go back and watch the press conference then. Well, this press conference was very different. In fact, what was going on in the press conference, if you saw it, the market was doing this. And at 3:15, Powell answered a question and then said, thank you, and then he just took off. I mean, abruptly. He answered the question and abruptly left, and then a little while later, the market did this. I think that somebody was giving him hand signals from the side saying, cut it off, the market's rallying. You risk saying something that you don't mean. Get the hell out of there. And he got the hell out of there. But this statement leaves nothing to interpret when you put this in as saying, hey, we're not seeing what we said we saw last time. That's gone. We're not even looking at the economy anymore. Let's look at some global yield curves. We saw Canada last week fully inverted, still is fully inverted. The U.S. has more inversion. The only upward slopes are versus the 3-month. Germany has some inversion. Italy has some inversion going on as well on the 30 to the 10-year. Probably the bigger story is, let's go over to global yields. Let's go right over to Japan. Japan still has some negative yielding debt, but down here at the 10-year, that 0.23, that is a very interesting sell. There is a desire to keep that yield at 0.25 or less. And that involves buying the 10-year Japanese bond. So they have to keep buying it, which means you need yen. Well, there's two ways to get that done. You spend yen you have in your pocket, or you print yen. If you print yen, you lower the value of the currency. Well, there's another problem, is they seem to be drawing a line in the sand at 145 yen to the US dollar. Print yen, you can protect that 0.25 for as long as you want, but you can't protect 145. Use your own yen to buy this. You could probably protect 145, but you're not going to protect 0.25 here because at some point you run out of yen. So you have to get yen from somewhere. Well, Japan is a large holder of U.S. treasuries, over $1 trillion. So they can get two things done at the same time. You can sell treasuries, then use those U.S. dollars in the spot market to buy yen, which would drive the value of the U.S. dollar down against the yen, drive the value of the yen up, and use those yen to buy treasuries to protect that 0.25. That is about the only pathway you can use to get that done. You can use your US dollar reserves until you're out of reserves, then you start selling treasuries until you're out of treasuries. At some point that runs out. At some point they're going to lose on one of those two fronts. They're going to lose on the 145 yen to the US dollar, or they're going to lose on the 0.25 on the yield on the 10-year. I just don't know which one it's going to be. The bigger question, I think, is does something break in Japan first, or in intervening in the currency and trying to cap this yield at the same time, does something break in some other market? So we're going to look at some emerging markets, and we'll look at some of the debt emerging markets have that are denominated in US dollars. All right, a lot of interesting stuff on this screen. And when we look at publicly traded companies, capital can either be in the form of debt or in the form of equity. And that is one market. Basically, you have a fixed income market for company or corporate debt, and you have an equity market for corporate equity, and then you have your government market. We've already looked at some government yields. Let's look at, well, we know what happened in the equity market last week. We had a significant sell-off. We're sitting on a double bottom on the S&P 500. And let's have a look at what happened to corporate yields over that period of time last week. 3 basis points. Spread widening on investment grade. Only 14 on high yield. To put that into context, the 10-year widened by 24 or the 10-year yield increased 24 basis points. I shouldn't say widen. It increased 24 basis points, and high yield spreads widened 14. Double A only widened 1 basis point. Triple B, which is triple B minus, is the lowest in investment grade, so this is just one above the lowest in investment grade, only widened 3. Double B, which is the upper part of high yield, it's still high yield, widened 10 basis points. Think of what happened last week. Treasury yields hitting the highest of the year. Real yields the highest of the year. The equity market sitting at the low of the year, revisiting the low of the year and finishing just above the low of the year. And corporate spreads are going, meh, we're not concerned at all. Here's the OAS, here's the yield. These are the OASs you'll find in this column. Here are the yields on different bonds. Let's look at emerging market corporate. These are corporates now, not government bonds. Investment grade emerging markets, 161 basis points versus the US here at 148, just 13 basis points higher. These are emerging markets now. Emerging markets. I want you to just think about that. High yield 776 versus 491. If you go into corporate debt that is denominated in US dollars, these are companies that are going to have to pay back this debt in US dollars. Look at investment grade here, 158 basis points, actually lower a lower spread than in the local currency. 158 versus 148, and on high yield 662. The credits market, we call corporate bonds credits. The credits market is going, nothing to see here. Whereas the government yield market is saying a different thing, and the equity market is saying a different thing. The corporate bond market is saying, we're good. You guys do what you got to do. You sell off. You do your panics. You do what you got to do. We're good. And if you look at the highs of the year, it was all back in July. The high on high yield was 599, sitting at 491. It's not even as if we're about to set new highs. You're 108 basis points away from even matching the high yield of high yield. 148 versus 167, 83 for 98 here, 184 at 208. Again, none of these are even close. Look at this one for double B, 327 versus 422. This one is getting close, 11.96 versus 12.26, but it's triple C or lower. Why it hasn't already exceeded it by 200 or 300 basis points is a question. Why we haven't seen new highs on the OAS is a question. But there we are. So something is wrong. Either the D is mispriced or the E is mispriced. They both can't be right. Now, they can both be wrong to some degree, but you'd have to sort of look at it and say, who do you agree with more? Do you agree with the credit spreads, or do you agree with equity prices? So what I did is I took GM and I used a bond yield plus risk premium method to get to the return on equity. And the return on equity I estimated as 1 divided by the earnings yield. I get 18.68%. And that should be a combination of the corporate bond yield for GM plus some risk premium. GM has a, down here we see triple B minus. These are Fitch ratings from 2016 up to 2022. They were triple B, then they were triple B minus. And then from triple B minus, they are now on positive outlook to be upgraded back to triple B, which would lower their cost of debt. But from triple B to double B, there are 3 notches in there. So I just did a linear interpolation to get the 6.22. That gives them a risk premium of 12.46. The risk premium over triple B has an average of about 570 basis points. So we can say, okay, well, let's say that it's 600 basis points if we're looking at triple B minus. So if this is 6.22, then the risk premium, if it were 600, this should be 12.62. We're at 18.68. So either this is too low, either this 622 has to go higher. In other words, the OAS is too low on these, or there is something wrong with earnings or something wrong with the price. Either the price would have to go lower given these earnings, or these earnings would have to be significantly higher given this price to get back to 600. Now, when we say average, it is an average. Being that we're at 1,246 as opposed to 600 on the average, we're probably outside of a 95% confidence interval on that one because we're more than double. If we use CAPM, GM has a beta of 1.25, and I'm using the implied equity risk premium on the market as it exists today, along with a 20-year yield, 3.87 on the 20-year, to get to 6.84 because CAPM uses a long-term yield. 6.84, that is an equilibrium model. From there, you would look at whatever cost of equity or return on equity that you calculate, and you would determine whether the stock was overvalued or undervalued. And this is suggesting that we are massively undervalued, unless there's something wrong with the equity risk premiums or there's something wrong with the bond yields. One of those two things has to change. I think that these have to go up. I think that these are just undertelling the story right now. On the other hand, you could argue that, well, wait a minute now, balance sheets are a lot stronger today than they have been going into any other recession, which means on a cash adjusted basis, the debt might not be that risky. Because if you look at a company's net debt, that is debt minus any cash or cash equivalents that it has, its net debt, if it took all its cash and cash equivalents and paid off its debt, what would be its net debt? Maybe these ratings and these OASs are not reflecting the debt level, but the net debt level. And if there are plenty of assets left to back that up, it could be that, yeah, you might have default rates, but recovery rates are going to be very, very high, in which case the OAS is going to be low. That could be the case. And if that is the case, then equities are selling off way too much. That puts a floor under equities in that case. One of these two markets are wrong. One of them is wrong. So we're, week to week, we're going to keep watching the OAS. I think the OAS has gotten a little bit more important because if they don't widen, then equity prices have gone too far. That would be a nice signal to start moving into equities. And what we would want to do is we would want to find the ones with the largest risk premiums available. And, you're going to do some stock picking. You'll find the ones with the largest risk premium and say, is it worth it for me to get in with that risk premium? Even though it's that big, doesn't mean that it's an automatic yes. It could still be a company that, no, this company's going to have a lot more pain ahead of it. But I think that would be a good way to start picking stocks now, is which one is offering the highest risk premium. If we think, if we don't see these things moving at all, then equities are underpriced. Okay, let's move to the housing market. Housing Market Index. This is the NAHB, National Association of Home Builders Housing Market Index. It's a diffusion index. Anything under 50 is contraction. Anything over 50 is expansion. We're at 46. August was 49. September is 46. So we are still in contraction. Single family sales present, not in contraction yet, but for the next 6 months, the forecast is in contraction. Look at the big drop there, 61 down to 49. Why is this not writing on the screen here? 61 down to 49, over to 47, 46 still dropping, and traffic of prospective buyers has been dropping for quite some time. Building permits for August down 10%. July was 1,685,000. August was 1,517,000, which is a drop of 9.97%. So there is where we are right here. I drew a low on each, during each recession. You hit the lows within the recession. Notice that you're in the recession each time when you hit the lows. So we may still have some downside left to go. But when we draw the line across, we can still see how elevated it is compared to all of this period of time under the line. That even though it's down 10%, it's still fairly elevated. This is promising here. Housing starts in August, up 12.2%. July was 1,404,000 on an annualized basis. It says here thousands of units, seasonally adjusted annual rate. August was 1,575,000, which is an increase of 12.18%. And again, we're over here. You can't see at this very corner here, but if you zoom in, this was July, this is August. That is a V in here, back up to this line. And there's the levels compared to history, compared to the levels in history going back. Existing home sales down just 0.4% in July. Annualized run rate of 4.82 million. August 4.8 million. That's a negative 4.15. We're going to look at a PowerPoint presentation shortly from the National Association of Realtors that puts out this number. First, let's look at mortgage applications. Housing starts up 12.2. Mortgage apps up 3.8%. This is for the week ending September 16th. The 30-year during that week averaged 6.3%. Refi index up 10.36. Purchase index up 1%. Mortgages last week, year-to-date highs. Not only are real yields, government real yields hitting their highs for the week last week, not only are many of the key rates hitting their highs on the par yields last week, but all these mortgage rates are hitting year-to-date highs as well, and there are corporate bonds well below the highs of the year. Do you see the question mark that we're hitting? And you have equity markets hitting the lows of the year, except for the credit market. Something funny in the credit market, right? 6.7% versus 6.35 last week. 6.25 here versus 5.75 for an FHA mortgage. Let's have a look at this PowerPoint. Okay, the link for this is in the description box. There's not many screens here. I think we've got about 8 screens to look at. Total existing home sales, seasonally adjusted annual rate. There we are at 4.8. Bottom of the pandemic here, when the economy was shut down, went down to 4,070,000. We're sitting at 4.8. Pretty significant drop off here. When we get to pricing, it's not so clear cut. Yeah, we are seeing this drop here, 413.8. This is the median price of existing home sales. 413 down to 389. But if you find every February and you draw a line up, you'll have price increases from February till this is 2019-06, every June, and then you tend to drift off until you get to another February, and up we go. This is the pandemic year, so it's sort of meaningless here. This is a February as well, all the way to June. June has a drop off in price. Then we increase to February. Then we start dropping again. So this drop down here comes as this natural drop off that we normally get in the second half of the year, just a much sharper decline. So a decline would have been natural. This is just a much sharper decline. So you can't take 100% of the decline and attribute that to a slowdown. Some of that decline is seasonal to begin with anyways. So you would have to say, well, look, this 413.8 would have declined to something anyways. We're at 389.5. Maybe only 80% of the decline is attributable to the state of the economy right now. Existing home sales median price percentage change year over year. Look at the drop off you have over here. This is August, 7.7%. This is the percentage change year over year. You're getting into some single digits, even pushing down into mid single digits. So if that continues on, that's going to do a lot to bring down that 32% of CPI that's attributable to housing, rents, and owner's equivalent rent. The total existing home sales percentage change year over year. This is 2022. This is June. You can really see it start to fall off. May, June, July, August, down 20% here. This is going back to last August 2021. So it was already, the existing home sales were already dropping off to some degree. Higher prices were already causing this to happen anyways. Now higher rates have really accelerated that. And again, revisiting the prices, you're not really seeing that much of the pullback. Even at 389.5, it's still higher than it was back here. This is in February, 354.3. What else do we have here? This is interesting. You're going to like this. Cash sales. And the darker bar is August 2022. 24% are cash sales. 24%. 16% are sales to investors. So roughly 40% of the homes being sold are either cash or to an investor market. 29%, this is 29 of the remaining 60, 29 are first-time buyers. Look at where distressed sales are. Way at the bottom down here. And this time you're not going to see that much of it because you didn't have that kind of mortgage malfeasance going on in the mortgage market like you did in 2006, 2007, or the lead up at least to 2007. So I don't think that that's going to cause enough to cause a lot of supply to come to the market. So I wouldn't look to distress sales like we did on the last cycle. I wouldn't look to that at all. Days on the market still faster, even though we are where we are, 16 days on the market. By region, not too much interesting here. Sales price by region. The last one's rather interesting. Percent change in sales from a year ago by price range. For those houses $1 million or more, the change in sales from a year ago down 5.3%. 750 to $1 million, only down 3.2. Mid-market 500 to 750, only down 2.2. It's down here. The lower income buyers buying lower priced properties where you have the biggest drop because they're probably the most interest rate and most inflation sensitive. So it's this lower end of the market that seems to be hurting a lot, but this is rather interesting. The 500 to 750, the 750 to $1 million, those aren't very big drops. This is the percentage change in sales from a year ago. Now, if we look at this chart up here, this is existing homes percentage change from a year ago, 20% to 19%. Big numbers here, but when you bring it down to price range, 2.2 and 3.2%, versus, look at this, 26%, 14%. I still think you can get into homes at 250 to 500. I don't know what you're getting into at 100 to 250. I don't know what exists, but there are all sorts of small counties and small towns all over America where the price increase really didn't hit because there was really no compelling reason to be there unless you lived in the area to begin with. But I'm not sure what you're getting for this price. But these are clearly targeting the lower income families or lower income individuals who probably are the most sensitive to any change in price. Especially from inflation and from interest rates. So that's not so surprising. But this, well, that's kind of promising, isn't it? Okay, let's get to the really interesting story for the week, which is the huge double bottom on the S&P. It held the bottom and it closed above the low. The last low closing was 366.33. That was the closing. It hit a low of 362.17. On Friday, we hit a low of 263.29, not just about a buck higher than 362, and we closed at 386.24, which is above the 366. And it's the closing that matters. If you close above it, that bottom is still in play. Well, this is a double bottom now. And if you see this little green line here, you see the little green above here, right across, that means that I am long SPY. So I was buying under 365. That's why we have this line across here. It shows green, which shows that I'm in the money. If this thing turns red, that means we finish below that line, and it means I'm losing money on those positions. If we look at the implied volatility at this point in time, and at this point in time, it's about the same. So it's about the same type of, I don't want to say fear, but the same type of speed of selling. It's not as if implied volatility really spiked. It revisited the same levels. The implied volatility percentile that we're sitting at right now is 91% on a 52-week basis. This is interesting here. We're at 100% on a 13-week basis. That means going back 13 weeks. We ended at the highest implied volatility over the last 13 weeks. And again, about on par with the implied volatility last time. I'll explain this trade here in a second. So this is a strong technical indicator. We closed above the last low, which in itself is a rather bullish signal. What would be the best course of action at this point is to test that bottom for a couple more days, is to bounce along the bottom and then start to rise off that bottom. The more you bounce off the bottom, the more psychologically hard that line then becomes. If support holds, I think you could trade up to 17 times earnings, because we're sitting right now, the forward EPS is 230. It has come down to 230. SPX closed at 36.93.23, gives us a forward PE of 16 times. That if the bottom holds, I think you could trade up to 39.10. You could trade to the next fundamental level, which is 17 times earnings, up to 39.10 before the fundamental question gets called into play again. If you have a solid close at 2% below the previous low, 366.33, so if you take 98% of that, you get the 35.90. Any close below 35.90 would probably induce more selling. because then the support line would have been broken, and then it would become resistance. And the harder the support line, the harder it is as a resistance line as well, which means you could be looking at a 15 or 14 times level without changing the EPS. Let's just accept it. 15 and 14 gets you to 34.63 and to 32.33. So a low-cost scenario or a low-cost trade that would say, well, I'm worried about 35.90. I don't want, if we break down below 35.90, chances are we're going to sell down another leg. You might see that 3,400, the 32 to 3,400, which we've seen that number thrown around by some analysts. The October 359 put is $7.54. And if we think that we can rally back up to 17 times or 3,900, we can sell a 390 call to offset that cost. We can get this trade in for $4.64 or 464 US to bet on, or not even to bet, but to hedge against a breakdown below 35.90. Because if we do close below 35.90, that is a very strong indicator that that support is now broken and it is going to be resistance, and there's going to be another leg down. And that leg down, I use multiples to get the leg down because I don't like drawing lines. If a line is at a fundamental level, I don't mind using it. Between 32 and 3,400, and this is a 35.90, 359 put that's going to cost you $4.64. So if this goes all the way from 359 down to 340, that's a $19 move for $4.64. If we invert our multiple, our current multiple, you have an implied earnings yield of 6.24. And since these are all large cap stocks in the S&P 500, I just assume, okay, let's say that we have a blend of investment grade here. Let's just use the investment grade yield. Investment grade is yielding 5.38. Given this multiple with these earnings, your earnings yield is 6.24. You're not sitting that far above the investment grade yield. If we use a 3-month implied equity risk premium or a 10-year, you get to 3% and 2.55 on the market. 3% and 2.55, and that is just assuming that earnings are going to come in pretty much where you anticipate, or that quarter over quarter you're going to have 0% growth. You're not going to have any growth, but you're not going to drop in value. You're just not going to have any growth. I don't know if that's going to be true for next next quarter, especially for guidance, because we're going to look at sector performance for the month in a second. And energy really helped out in Q2. I think energy will probably be okay in Q3, but I think the guidance for energy, based on what we've seen month to date, if energy companies are expecting lower prices because we have a global recession coming up, then I don't know that you're going to get any growth out of earnings. That maybe this number is wrong. And if this number is wrong, well, then your multiple is too high. If we're expecting this number to go down, the multiple is too high. This might be an actual reality. I don't think so right away. I think we had a nice solid finish in a Friday. In the last 15-20 minutes, you had this nice rally into the close to get us to the closing price of 36.93, or on SPY 386, well above the 366. $20 above, or 20 points on the index above that. Goldman Sachs year end 3,600. All right, here are our sectors year to date. We're going to go month to date in a second, then look at the last 5 days. But look at the outperformance of energy versus everything else. In fact, energy and utilities are the only two positive performers for the year. And we should see, the defensives at the top. There's staples, there's healthcare, and at the bottom you've got communications, technology, consumer discretionary, real estate, materials, financials coming in the middle. Let's look at the month to date. Look at energy. Energy just took a dump. This is over the month of September. We've seen energy prices coming out in September. Well, that's 1/3 of the quarter. So prices are dropping into the end of the quarter. So perhaps the guidance given previously for energy earnings might have been a little too high, because if you're taking out 1/3 of the quarter, and then once they do report, do we expect energy prices to recover, or is energy going to reflect a global recession before it starts reflecting the fact that, well, you have no capex and no future capex in energy? Interesting to see what's going to happen. We should expect to see, leading the pack here, even they're all down, but we should expect to see the safe sectors, the haven sectors outperforming, which would be healthcare, followed by utilities, and there's consumer staples. These are the three places that if you need to be in equities and you need to hide, that's where you would like to be. You don't want to be in, there's communications, also technology is down here, and consumer discretionary is over here. So just being in healthcare, you're only down, this is month to date, only down 1.24, utilities down 0.282. The S&P for the month is down 6.6% for the month. I am down a little over 2.5% for the month, because as some of you may know, in the Q&A for the week, I did mention that I sold some calls on XLY because it has higher implied volatility. So I can sell calls on SPY if I think the market is going down, or I can sell calls on XLY because if the market's going down, XLY will go down by even more than the market. And it has higher implied volatility, so dollar per dollar of margin, I will get a higher return. And I closed those out. I got 302 for them. I started closing them out at about $1.60, and I closed the last ones out at 35 cents. It was a beautiful trade. I'll say more about that type of trading shortly, because somebody had mentioned that they don't like that kind of active trading. They called it day trading. I don't day trade. There are times where, well, I may as well talk about it now. There are long periods of time where I'm buy and hold, where I just hold on to something. I buy something and I'll hold it for years. And I will judiciously play the options to generate more income than its growth and its dividend supply, just by selling parts of the distribution that I don't think are going to happen. And I'll do that for years on end. And I like those particular markets because you can pretty much get your whole week of work done in 35 minutes, 40 minutes, and you say, okay, I'm done for the week. The way the markets are right now, it's 2-3 hours a day that you have to keep paying attention to it. And you have to keep adjusting, and you have to keep anticipating, well, where's this going to go? Should I be increasing or decreasing my exposure? Should I buy more of this? There's just a lot more work, but it's more, the work that I'm doing is more active. In other words, it's more about alpha than it is about beta. In long bull markets, beta exposure and lean into it. In these kind of markets, beta exposure isn't really going to be your friend, that you're going to have to get some alpha going on. So you do have to get a little bit more aggressive on the way that you generate trades. So it is only during these periods of times that I am more active than I normally would be. At other periods of time, I can think of some years, 2016, 2017, where I think I'd go 2-3 weeks in a row without doing anything, because nothing had changed from week to week. There was really nothing to do. You look at the economic data, you go, there's nothing here that says I should be doing anything differently than what I'm already doing. The only decision you had to make every so often is, okay, I've got cash that built up. What do I do with it? Do I buy this one or do I buy that one? And that's it. So I'm only active and doing the things I do right now only because the market is doing what it's doing. And to be down a little over 2.5% for the month, which it hurts, is a lot better than being down 6.6% for the month, which is what a beta portfolio would be down right now. All right, let's jump back to this screen for a minute and talk about this little thing in the corner here. SPY, short interest right now is 17.73%. I'll show you on Koifin how to get that number for any stock that you have if you want to look up what the short interest is on it. But it only gives you the short interest percent, and it'll give you a chart of the short interest. If you want more information on short interest, like the amount of sales in a day that were part of the short interest, there are sites that can do that, and I am working on a subscription discount right now. I found a fairly low-cost site that provides a lot of information around short sales and short selling, and they provide things like short squeeze scores, things like that. If you're into that kind of stuff, it's low cost enough to be a retail subscription. I think it's somewhere around $30 a month. However, because I have a large enough audience, let me negotiate a discount first. Let's see how low they're willing to go. Maybe 10% off like Koifin, maybe even more. I don't know. Let me negotiate that first. I only found it on Saturday morning. I found a couple of sites that are good. I'm going to reach out to each one, get a little sample subscription on each one, see if they give me a 1 week subscription so I can test each one out, take the best one and say, well, what are you willing to give? Let's see how we find the short interest on Koifin. Okay, at the top up here where it says search for a name, ticker, or function, just open that up. This little window will pop open, type in SPY, and it's right here. And then you have a whole bunch of things that you could look at. Well, these are all blocked off down here, but you have a bunch of things that you could look at here. Just go with overview. You can actually look at short interest down here, but if you go with overview, you'll get a screen that looks like this, and you get a bunch of information down here, which also gives you fund flows as well. Your short interest is over here. If you hover it, a little graph pops open. You can see this goes back all the way to July 2020. You can see in bold where it says January 22, you could see the short interest just increasing throughout the year. So we're sitting at 17.73. If you want to know how many shares that is, let's get rid of this graph here. Shares outstanding, 903.58 million, multiplied by 0.1773. You'll get the number of shares that are short. And then it has your performance returns 1 month. You can see where are we year to date. Sorry, 1 month. 1 month, the price is down 10.77. Sorry, when I said it was down 6.62, I meant for the week. I was for the month, yeah, it was down more, 6.62. So what I said earlier about the month, change all of that to the week. What is this number down here? It says total. This is a price return. This is a total return. Total return has the dividend. So you're not really down 10.77, you're down 10.4. And I think it uses a continuous dividend to get that in. So it just uses the yield as opposed to when you actually get the dividend itself. And then your funds flow down here as well. There's your expense ratio. But if you wanted to know where to get the short interest, you could do that with any name. There's Tesla. You can type that in and you can go right to where is their short interest percent, and it'll give you, it's really dropped off. I guess that big rally caused that short squeeze and it's really dropped off, right? You can get killed shorting this stock. Okay, before we look at the week coming up, I thought I would give you a view of what I see the next bull cycle being about, some big themes for the next bull cycle. And I've already started to build positions in these areas. Mexico, I think, is going to be a big story. You have lower labor costs versus China, plus you have more favorable demographics. Mexico also has its own domestic energy production. There's no ocean across. Now, because of this, if I'm right on this and you get a lot of jobs and investment moving to Mexico and there's no ocean across, that's negative. That's going to be negative for some ocean shippers and some services. I can think of container services. I can think of the container shippers. It also reduces immigration flow. That seems to be a thing that the U.S. is trying to get done. Make Mexico a land of opportunity. trying to make the U.S. great again. Make Mexico great. If you make Mexico great, you solve your immigration problem, because as they're moving up from Central America into Mexico, they're going to say, hey, wait a minute, here's the border. All the jobs are over here. Why don't we hang out down here? This is exactly what we want, all these jobs. And you fix your border all at the same time. Housing. Undersupplied. Canada and the U.S. are undersupplied, and Canada has very generous immigration policies, so that's only going to get worse in Canada. So the home builders, I think, are a great place to be. Some can build to rent, and some are already building to rent, so they don't really need traffic flow and sales. If they have a bunch of houses that they built that are not selling, they can quickly turn them into rentals. D.R. Horton does this. KB Homes reported last week, not so great, but they're not big on renting. Lennar reported last week, and they did very well, and their stock price got a nice little boost. KB Homes sold off, Lennar was bid up. Home builders, they can build to rent, they can build to sell. And I like D.R. Horton because they do have a very large growing rental portfolio on their balance sheet. And at some point, you can sell all of that off to a BlackRock, or you can spin it all out into a standalone REIT. So there's potential there. Also, next trend, transition to a carbon-free environment, or a carbon-free world. You're talking about the grid and machines. When I say machines, it's any machine. Cars, I call a machine. Any machine. You're going to be moving to battery technology. That's bullish for materials: aluminum, copper, lithium, nickel, cobalt. Employment. Just look at Ford and GM. Ford is going to be building its new battery facility in, was it Tennessee or something? Somewhere down there. 8,000 jobs. GM's Ohio plant, 4,000 jobs. And they're looking at another one, I think, in, was it Indiana or Minnesota? I forget which one, but they're looking to build another one as well. And for the carbon-based companies, the oil and gas companies, you're going to have continued low and no carbon capex. So I think you're going to have huge amounts of shareholder cash flow coming out. So you can think about the present value of all future reserves versus the current price, because, well, they're not going to locate any new fields. They're just going to deplete the fields they have. Well, what is the present value of all that going to be worth, right? And listen, if you have an upside down demographic profile where this is the young age and this is the older age and these ones are moving off to retirement, and you are not going to fix this problem with immigration, you're going to have to increase automation. You're going to have to increase technological progress, because your output is a function. If you use a Cobb-Douglas production function, you have A K alpha L1 minus alpha, roughly, looks like that. A is technological progress. So if you can't increase L, software and automation, so robotics, artificial intelligence, I think that's a big trend going forward. I don't know who the winners there are going to be, but that's something to look at. For materials, even though aluminum is taking a beating right now, I've started selling $30 puts on Alcoa. Alcoa's in the mid-30s. Aluminum is not going away at all. If you want battery range, you got to make these vehicles lighter, which means you're not using steel, you're using aluminum. So the truck boxes, as Ford is using aluminum now, I think that's going to become more and more so. You got to make those vehicles lighter. So aluminum is just on tap for that. A lot more copper used in an electric vehicle than an internal combustion vehicle. And if you are going to be doing anything with the grid, copper. Electricity travels along copper at half the speed of light. What's the speed of light in physics? C, so half C. Half C. Lithium, nickel, cobalt. You're going to need a lot of that as well. So I'm already building a position in the Mexican peso to take advantage of this. I'm already in the XHB. I also sold $53 October puts on the XHB on last week's pullback. I am looking at doing some kind of straddle on Lennar, selling a straddle. I already have a straddle on DHI, a short straddle on DHI, and I sold $40 puts on Pulte Homes. So I am, moving into that. For this over here, I'm selling puts, $30 puts on Alcoa. I do have puts on Rio and I got so many things going on, I forget the name of it now. It'll come to me as BHP. There it is, BHP. Puts on Rio and BHP. I'm also re-adding to my GM position, and I'm adding to Ford again. For GM, I held this for a long period of time, and I kept screaming, use your buyback, issue a dividend, do something to support your price, and nothing. Second quarter earnings came out, nothing on the buyback, nothing on the dividend. So GM was rising in price, and I wanted out, so I sold August expiration. I sold calls such that they would be called away from me, and my average price was about $39.30 on the call away from me. And the morning of the options expiration, GM came out and said, we're raising our buyback to $5 billion, and here's your dividend, 9 cents. Oh, I was pissed. Seriously, I said, on the very day that I'm going to exit, you do this. Seriously, I was pissed. Anyways, I watched it go all the way up to 40, 41, 42, and I thought, oh, come on, really? Well, then it's, we're into 35s now. My average exit was 39.30. We're down around 35.30. I started adding to GM at these lower prices. Well, that's a $4 drop from where I exited, which is the same as lowering my average cost by $4 because I wasn't out of it for 60 days. And because I wasn't out of it for 60 days, the loss that I generated by it being called away from me is not useful because I'm getting back into it now. But it is the same as lowering my average cost by $4. So I am getting back into GM. With Ford's drop in price into the $12 range, the low 12s, I am adding to Ford as well. So just to get an idea of where, now this is, I don't expect any of this to pay off for, I plan to hold these positions for years. The peso, I'm using the currency to play that one. I don't know where it's going to go, but I'll use the currency. I'm using the home builders and the XHB at the same time. I'm into the automakers, GM and Ford, and I'm using Alcoa, BHP, and Rio. And I just haven't made a decision down here on how to play this one yet. But I am looking at how to play that one, just to give you some idea of, how I think about seeding the next field. And I'm seeding this field. This is a field that I don't think I'll be harvesting for a number of years. Okay, so with the week coming up, we have a double bottom on the S&P 500. Does it hold? Do we rally? Working against us is a whole bunch of Fed speak. Just in case we didn't hear them, they're all talking this week. So if we can live through that, right? So this is September 26th, which is tomorrow. Collins and Bostic and Mester to start the week. Just in case we think we're going to rally. They're going to be here at 10 o'clock to make sure that things are in line. They're going to show up at 12 o'clock again, and then they're going to show up at 4 o'clock and read us the riot act each time. Going into 27th, before the market even opens, in case you think you're going anywhere, Evans is going to have a go at it. 8:30, we have durable goods orders. Home price index at 9 for July. And then 10 o'clock, Bullard's going to come out and, read the riot act again. I tell you, it's like every 2 hours next week. So we got to get through that. We're sitting at a double bottom just below the low of the year. And you have all of these guys front end loading their stuff on Monday and Tuesday, giving the market no time to do anything. New home sales. That'll be interesting. That's for the month of August. We saw existing home sales up 12.2%. Let's see what happens to new home sales. Let's see, what else do we have here? Daily. Then you have mortgage applications. Goods trade balance, that'll be negative, but will it be better than the 89? Retail inventories, then you have Bostic, pending home sales, then you have Bullard. Like I said, they're all out in force this week. I think that they really want to try to keep financial conditions where they are. Speaking of financial conditions, do I have that available somewhere? I do. So here we are, and this is a week behind. So the best that we can do is September 16th, but we can see the little. This is the problem with hovering over this, is all this garbage comes up with it. But you can see what I'm pointing at here, right? We're heading in the right direction, but you got to get above the zero line to get into restrictive territory, and that's where they want to go. And I don't think they want to take the chance on the leverage factor getting any worse, because if we zoom in over here, it does look like the leverage factor from the 9th to the 16th actually got bigger. What did we have? Leverage negative 0.07, negative 0.08, and we need that to be on at least 0 going to the positive side. Well, I don't think it gets there, but at least getting to 0, right? So let's get back to where we were. So there's Bullard. Then you have Evans. And on the 29th, GDP growth rate for the US, you have GDP for July. It's so backwards looking in Canada all the way to July, and you have your preliminary for August. Q2, there's your final look at Q2 GDP growth. Continuing jobless claims. This is not the continuing. Where are we? We want the initial jobless claims. Remember, I said we're looking at 300 as the mark. Once we start getting at 300 or over, we can start thinking about no job gains month over month, and maybe even job losses. Well, last week was 213. From 225 to 213, going in the wrong direction, getting even stronger. Let's keep going. Lane, Mester, daily. And then you have PCE on Friday. This is the Fed's preferred measure. PCE on Friday at 8:30. And just in case it comes in lighter than expected, Brainerd will be there at 9 o'clock to beat the crap out of you. I don't know that there's been a week with more people speaking, and Powell is speaking twice. It's just not on this calendar, but Powell is twice next week somewhere. I just don't know where he is, but he's speaking twice somewhere. I should have done a little bit more looking around on that to figure out what's going on. And there's Williams at the end of the week to sort of just, get you ready for the week after. There it is. If we can survive all of that Fed talk, Friday, the last day of the month, is PCE. We've already seen CPI. PCE generally comes in below CPI because it has a lower weighting for owner's equivalent rent, a significant lower weighting. And it doesn't count a basket of a fixed basket of goods and services. It's based on expenditures. What did people actually buy, as opposed to what is the price of things that are for sale? It's based on what they actually buy. So it does come in lower. It is a measure of the cost of living, not the price index. And that's what the Fed likes to watch. If that comes in hotter than expected, well, then like the CPI, I think, it's going to put some downward pressure on the market, along with all those Fed speakers. Are they going to be paid attention to? I don't know. They weren't last time. Between the July meeting and Jackson Hole, you had Fed speaker after Fed speaker after Fed speaker saying, you guys are living in a fantasy world if you think we're going to pivot, and the market just said, we don't believe you, and just kept going higher and higher and higher. Is the market going to do the same thing, saying, oh, you guys aren't important. It's only Powell that's important. We're just going to ignore you. I don't know. But it'll be an interesting week because government yields have hit the highest of the year. The market has hit the lowest of the year. The US dollar is at the highest of the year. The pound is at the lowest of the year. The euro, the lowest of the year. The Canadian dollar, everything is at extremes, except the credit market, except corporate bond yields saying, there's nothing to see here. Everything is just fine. We're doing okay. How you guys doing over there? Something's going to have to give somewhere. I just don't know what it is, but I'll tell you, it's going to be interesting. So I should end with a word about the Koifin subscriptions. I was able to negotiate with them that anybody who subscribes from this source, from me as a source, gets 10% off whatever the price happens to be. There's a link in the description box. The first link will do that. What I did not ask them was how long that was going to continue for, because I said that this is going to be important for a module that I'm doing for the applied series, which is the top-down module. There's a big part of that called intermarket analysis. And you need very powerful charting features to do intermarket analysis, because you have to do analysis between asset classes, which most brokerage charting functionality doesn't really do. It'll do like one asset at a time, or relative value between two assets in the same asset class, but not between different types of data series. So I said that would be coming out between, not between, but for the months of November and December, that series would be hitting the website. I don't know how long that 10% discount is in place for. I just know that it's there now until it's not there anymore. I don't know when it ends. Anyways, if you're interested in this, use the link in the description box, because it will give you the 10% off. I don't know if going directly there won't know to give you 10% off if you're interested in this. And I'm looking at trying to get some negotiation on that other subscription that has a lot more interest or a lot more information about short interest.